What is happening? We are 7 minutes late. I apologize. This was 100% my fault. You know how these things happen, calendar, schedule, etc. Jason, good to see you. Thank you for not killing me. Appreciate it.
All good, man. It's super fun to be on. And I love this intro music, man. It kind of pumps you up.
Yeah, I did that.
Let's do it.
I'm a composer. All right, so everybody, welcome back to Talking Wealth. My name is Michael Bannock, and I am 8 minutes late. Apologies again. I'm a managing partner at Ritholtz Wealth Management, and I'm excited today because out of all of the things in an advisor's tech stack, everything starts and ends with the custodian. The CRM is nice, the planning software, of course, it's a must, but where the assets sit, that is absolutely at the center of the client-advisor relationship. And right now, the space is dominated by a two-headed dragon. Of course, I'm talking about Fidelity and Charles Schwab, which has a collective $25 trillion. So I want to know, what sort of a maniac would dare to compete with such large and entrenched incumbents? Well, his name is Jason Wenk, and he is the founder of Altruist. I'm excited to talk with Jason about how he broke into a castle that is surrounded with crocodiles and such a wide moat. But first, a word from our sponsor. Today's show is brought to you by SS&C's Black Diamonds Wealth Platform. Are you an advisor who's looking to streamline operations, improve reporting capabilities, or expand your service offering? SS&C's Black Diamond Wealth Platform is expertly crafted to enable wealth management firms to simplify their tech stack, streamline operations, and better serve their clients. Acting as the cornerstone for all essential functions, Black Diamond drives everything from client acquisition and onboarding to proposal generation, portfolio management, a purpose-built CRM, an interactive client portal, and more, ensuring advisors can confidently achieve their business objectives. To learn how Black Diamond is helping wealth advisors of all shapes and sizes, visit sscblackdiamond.com. All right, Jason. So here's where I want to start. At the very tippity top. Why? How did you think that you can start a brand new custodian out of thin air to compete with some of the companies with an absolute vice grip on this corner of the business? Please tell us why.
I mean, you make it sound a lot harder than I guess I thought it was 7 years ago. But so look, I think at the end of the day, I suspect almost all businesses start because people kind of start asking the question, there must be a better way. And I think the same thing can be true. Like, why would someone start an RIA firm? Why don't we all work at Morgan Stanley or UBS or, whatever, Ever Jones? Like, the reality is there's tons of competition no matter what type of business you do in wealth, whether it's a custodian, an advisor, et cetera. But the impetus for me, like the why I was asking the question was, I built 2 RIAs. So I'd, kind of walked more than a mile in the shoes of advisors. And it started off with, like, I'd call it like a mild annoyance. And when a firm is small, you don't think of it as that big a deal, the things a custodian can't do. But as you start growing and you start reaching some amount of scale, and especially if you're growing really fast, then those mild annoyances become pretty major pain points. And eventually you start getting actually pissed off because you're like, this is ridiculous that we have to stitch together 7 or 8 different softwares. It's ridiculous that you can't just open an account in under a minute on your phone like you can at Robinhood or, Wealthfront or Betterment. Like, why is it advisors have, DocuSign and envelopes? Why can't we trade fractionally where everyone else can? So you start asking all these questions. And then I probably became like a conspiracy theorist because, like, I know why. It's all because of the money, like they want to get the rev share and they want you to hold extra cash in your accounts. And they don't care actually about the institutional business because it generates 1/20th the revenue of the retail active trader business, right? And so, I think there's, maybe I'm right about a bunch of those things. I don't know, but I think, if you get to a place where you're sufficiently frustrated and I felt like I knew how to fix the problem, I was going to go and fix the problem, right? So started Altruist 6.5 years ago. At that time, TD Ameritrade was still in the mix. So they were probably the company we looked at the most as one that was doing things the rightest, if that's the right phrase.
They were the good guys.
Yeah, and then they got taken out, a few months after actually Altruist was formed. And then it was sort of, I think, pretty deep amount of responsibility that we need to have another option. It can't just be Schwab and Fidelity, sort of 2-horse race. And, that leads to a real rent seeking, kind of approach to running a business. And that's not good for advisors or their clients.
So you said a lot there that I want to unpack in podcast parlance. So maybe let's start with this. How disruptive was Robinhood's free trading to these platforms? And as a secondary question, so, okay, that was a big part of the revenue. How exactly do these companies make money off advisors, especially maybe the cost that we don't see?
Yeah. So going to the Robinhood question, I mean, they were a huge inspiration for Altruist. I mean, not so much in like the way they do business, but their user experience. Like an 18-year-old could open an account, put $10 in it and start trading in, again, under a minute on their phone. But for a multi-billion-dollar RIA firm, you might spend 3 to 5 weeks to get an account opened, the assets transferred over, get it connected to your portfolio accounting systems, start managing the portfolios, et cetera. And it just seems insane, actually, when you think about it from first principles. You're like, why is that the case? So a ton of that has to do with, just sort of the age of custodial platforms. Most of these platforms are really old. I think Fidelity is 75 plus years old. Schwab's 50 plus years old. Updating the technology to work with today's UX expectations is a lot harder than I think people imagine. So when we saw Robinhood, they were just built from scratch as a collection of APIs or microservices, right? It was modern, it was clean, it was fast. Like they didn't really have any baggage, and with no baggage, you could build a much better experience. So that was certainly, played a part. The economic side also was something that really bothered me. I started as a quant, so just building trading algorithms, how I got in the industry. And so I always had a bit of a, curiosity around, how could you drive the best possible client outcomes? And then what were the custodians doing to make it hard? So like simple things, for example, like trading fractional shares. For me, that was important because I felt like if you really want to deliver the best possible client outcomes, you're probably going to be doing that with mostly ETFs and direct positions like direct equities or fixed income, et cetera. So you could compress the cost, you could create more transparency. Account minimums became irrelevant, so you could serve clients of all different kind of levels of wealth. You could do it really efficiently. Why weren't the other custodians doing fractional shares? Why do they still not do fractional shares? Obviously, when we started, they were still charging commissions. Like, why were they charging commissions when it was like 5% of their revenue? Most of these roads lead to the fact that if you are not supporting fractional shares, it's going to force people to have a little extra cash in your account. That extra cash in the account, of course, is the biggest way that most custodians make revenue. They're going to get net interest income. So that's kind of like, I think most people understand that, they're going to earn, like in today's world, it's like 4.5% is how much they're going to earn on that cash. They're going to pay you, like in Schwab's case, 5 basis points. That's a pretty big spread. They own their own bank, so it's not quite like that for them. They're actually lending and they have a whole loan book and there's a little bit more nuance to it. But in a nutshell, like that's a huge part of revenue. The other parts that are pretty meaningful, again, which I think fractional shares is a big part of this, is what is the only thing you can buy today that has fractional shares off the shelf? Do you know?
At the incumbents?
Yeah.
I don't.
Mutual funds, right? It's the only thing you buy off the shelf in fractional shares. Can't buy ETFs, right? Can't buy stocks. So if someone wants to create some scale by using fractional shares, you have to use mutual funds. And if you look at the mutual fund marketplaces, which is dominated by Schwab's OneSource, if anyone's listening and owns a mutual fund company, they're probably sitting there like getting like red face, right? Because the reality is like there's going to be a massive listing fee per fund, rev share, all sorts of crazy stuff just to have access to distribution. So if you're a custodian and you're like, hey, listen, I'm an advisor, I don't want my clients holding any cash at all. Your only path is to then go use these, like higher cost products, which oftentimes are higher cost because the custodians gatekeep the distribution by adding all these layers of complexity. Even the ETF vendors are getting squeezed. They're getting asked now for rev share. We saw, I think, a mutual friend, Meb, kind of, raise that maybe a year ago, where all of a sudden a bunch of ETF companies were going to get hit with these insane commission rates. Basically, if they didn't pay to play, right, to be on, sort of the commission-free, sort of ticker list. This type of stuff, is like the tip of the iceberg. I mean, there's a whole bunch of other things too that they do. I think if you're looking at like the consumer products, like a Robinhood, their payment for order flow has been talked a lot about. But the bigger story there is look at their execution quality. It's like literally, if there's like a regulatory minimum that all clearing firms have to meet, it's like the minimum to not get fined. Basically, it's like it proves that you mildly give a shit about your customers, basically. And Robinhood basically is like, can we just maybe can we get just like a mil better than the worst possible allowable execution price for our customers? And that allows us to make the largest possible spread, right, on every transaction. That's not good, right, for consumers. This doesn't drive better outcomes. So again, I could go on and on about this, but at the end of the day, if you're an advisor, you're hell-bent on driving best possible client outcomes. The custodians historically don't operate that way. Like they're not out there going, what things could we do to make it easier for your firm and every other advisor's firm to drive the best possible client outcomes? Instead, it's very much like, what could we do that helps protect our revenue? And
I think I don't know if you use the word extraction or it's something that I think about, but I don't know many RAs that are doing backflips for the sort of service that they're getting from their custodian. And I think maybe that's the nature of a duopoly, is that they have all of the leverage. What are we going to do about it? We can leave if we'd like, but that's where the money is. That's where the clients are for the most part. So what is it that you're building that right off the bat, for advisors that are listening that might not be super familiar with the story of Altruist, what sort of services are you providing that is just a no-brainer for somebody to take a look at what you're building?
Yeah, I mean, I think the thing that got people's attention initially was that you can onboard an entire household in about 60 seconds. So if they have 5 accounts, you want to do the ACATs, move money authorizations, link their brokerage accounts, their bank accounts, like all of the stuff, even includes your ADV, your fee agreement, like all of that. It's just like insanely fast. About half of all of our accounts are opened on mobile, so it's designed to be mobile first. You could do it with a client in person, or you could do it remote, right? But that's like the first experience people have, is they open that first account, and it's just sort of a mind-blowingly good experience. The accounts are validated in real time, so this notion of like NIGO rates, where something doesn't get fat fingered in a DocuSign, like that doesn't happen because we're validating, does this name match this social, match this date of birth. ACATs are typically done in 2 to 3 business days. So people are getting like, whoa, how is this even conceivable? I think a lot of people don't realize that all custodians' money's in the same place. It's kind of this strange thing where they're like, is my money safer at Schwab or Fidelity? It's like all of our money's all in the same place. We're all members of DTCC, Deposit Transfer Trust Corporation. And we all just have what's called the box number. So when you fill out an ACAT form, and it asks you for like the 4-digit, that's just the box number at DTC. And so when that goes in, DTC is just going, okay, this account's going from here to here, but the securities actually stay at the same custodian, right? Like it's all the same. All major firms that use ACATs, our money's all in the same place, right? So the same level of safety, security, and but if you're thinking about it from that perspective, why should an ACAT take a month? Like that's bonkers, and that's because people are sending in paperwork, goes to some back office person, they do some manual validation, then they go send a request, directly and manually to DTC, and then it gets processed.
But also, Jason, why should an NIGO even exist? Why don't they tell you, hey, you filled this format wrong? It shouldn't even allow you to enter anything improperly. Yeah. It should just get rejected.
Now you're hooking. Yeah. This is first principles thinking, right? Why should this? Why should that? And like, if you just think that way and you build it the way it should be done, I mean, that's effectively how we built Altruist. So those are the first experiences. As far as like why, like you should validate probably 95 to 97% of all accounts and services. Like, so if you're doing like an RMD or like a Roth conversion, right? Like 95 to 97% of all of those things should be able to be validated in real time automatically, completely eliminating the possibility of a NIGO. The edge cases are like pretty random, right? It's like, oh, if someone just turned 18, it's their 18th birthday, they basically have no digital existence, and so there's no way to really validate. That might be an edge case. You've got whatever trust that has like 7 successor trustees, and you got to do a little bit of manual review of like, okay, who are all these people? Like it's a little bit different than just like an individual joint account. But yeah, like the majority of that stuff should be automatic. And then we just continued that process, right? Okay, if I'm investing money, I talked about fractional shares. You should absolutely have those. It allows you to, if you want, you could have accounts that have $10 or accounts that have $1 billion, and they could all be invested with the same efficacy, right? The same holdings, like the same personalization, the same tax lot level customization around tax management. So built it that way, obviously commission free. We started thinking about the behind the scenes stuff too. So if you start getting rid of the need to process things, and if you get rid of the need for manual review, your ops team becomes much smaller. This allows you to have the lowest fee schedule because you don't have to do a bunch of weird nickel and dime fees because there's just not a lot of people involved behind the scenes. Everything's being done automatically. So these are just like examples. Now we then took like, I don't know, our approach is maybe a little bit unconventional, but we kind of took like both a bundled approach and unbundled approach. So we built the product as a collection of services. In plain English, like basically what that means is, if someone wants to use our product for performance reporting, fee billing, as their trade order management system, like all that stuff's built in, which makes it really easy for advisors looking for like an insanely simple turnkey solution that gives them the ability to kind of scale quickly. But for big firms that we work with, look, they're going to be multi-custodial. They're going to have different tech that they've kind of maybe been using for a decade plus. So it can also be fully unbundled, and people can use this as like a modern custodian. But like Black Diamond, who is sponsoring the show, is an awesome partner of ours that we work with, and have tons of firms that are using them as their portfolio accounting system. Same with Orion, same with Advison, et cetera. Right. So I think that the experience though that is consistent for everybody that tends to wow them is the onboarding. It's like we just kind of killed the onboarding, and then we make investment management incredibly easy and super cost effective for clients.
I have more questions on the tech part of it, but I don't want to forget this aspect. So we know that the fees that are levied by the incumbents are what they are. They get them. You are a not-for-profit business. I'm sorry, you are not a not-for-profit business. You have to make money too. I don't begrudge anybody making money. Yeah. So you are commission-free. You are not charging fees per account. So how does Altruist generate revenue?
Yeah, so a lot of the ways that we make money are the same as other custodians. We're what in software you'd call a vertically integrated solution. So we're not a monoline business. In other words, so we make net interest income, but we pay more of the interest to customers because we think they should get better overall returns. We make payment for order flow, but we make probably the least amount of anybody that I've ever heard of because we built our order routing system as what's called a wheel order routing system, where effectively it hits the market and it also hits all of the biggest liquidity providers, and it forces them to effectively do a bake-off. Who will give you the best possible price? That's where the orders go. Subsequently, occasionally it is a liquidity provider, occasionally it's the market, but whatever it is, it's always going to be the best possible execution that we can give for every single transaction. So again, we make PFOF, but it's a very small amount. We have a model marketplace. A lot of our users, they just want to be able to just push a button, turnkey, plug into direct index or plug into a BlackRock portfolio or Vanguard portfolio. So they can do that. We charge a very small amount compared to if they were outsourcing through like a TAMP or going directly to an asset manager. So we might be 50 to 80% cheaper than those platforms. But again, we make something there. We do charge for software. If someone's multi-custodial, they use our software to do things across their Schwab and Fidelity and Pershing accounts. It's de minimis, $1 per account per month after their first 100. But there's software revenue. So the thing that's interesting about Altruist is that in every area that we sort of have a product line, we're probably 50 to 80% cheaper than these solutions are if they were standalone companies. And then the things that are custody specific, we're just giving more of the economics to the end client. The really crazy part about this is we actually probably earn about double what Schwab does. And we don't know what Fidelity earns exactly because they're private, but Schwab being public, you can kind of do some math and figure out. So it's kind of one of those weird things where it's like, even though the customers get a better execution, they get better yield on cash, they get fractional shares, we have a lower overall fee schedule. As a business, we actually earn more on a gross basis, and our OpEx is lower because of automation, which just allows us to do way more R&D investment into the platform, provide more services at lower cost, right? So this isn't like unique to us. This is how Google operates. This is how Amazon, like anyone building a vertically integrated platform business that can do a lot of different things will have an unfair economic advantage over someone who's doing like a single thing, and they're doing it on a mainframe that's 50 years old with a service model that's 40 years old.
So you all were very deliberate in how you built the platform and making sure that you were able to provide in-house a lot of the tech services that advisors outsource. And it's my understanding that you've since maybe opened the aperture a little bit to be more friendly with outside providers, and you can correct me if I'm way off on that. But do you think that advisors have just too much tech in general?
Well, I mean, it depends on the advisor, of course, but yeah, I think since you asked in general, I think a lot of people would be much better off with a simpler, tech stack. There's a, look, we're all guilty of this to some degree. Like, we know that maybe a traditional person works somewhere in the neighborhood of 2,000 hours a year. A lot of advisors probably spend 500 hours or more, maybe even like 1,000 of their hours, sort of just like messing around, like playing office. Like they're not really doing prospecting. They're not meeting with new prospects. They're not engaging with clients or doing research or something that, it's like, they're just literally like in the office, like cruising social media, reading articles. I don't know. And one of the things they also tend to be hobbyists in is like, they get really proud of like building a tech stack, right? So they start cobbling together these tools. And then we have all these myths in this industry. Like there's this one myth that it just drives me bonkers, but it's this like notion, like every now and then I'll get some like industry consultant, which, like, look, I've already said like maybe I'm a bit of a conspiracy theorist, but these consultants, like they don't exist if the tech's easy and integrated. Like they exist to like help some firms figure out how to put this stuff together. But they'll say the myth is advisors want best of breed. And I'm like, dude, that 11-person company in Kentucky, whatever, that built whatever, some type of tax analysis tool or something, is absolutely not best of breed. Like that is not best of breed software. And like this notion that you're gonna have a bunch of like these tiny companies that have like 5 to 10 people and they're building these, kind of point solution products. And then cobbling 10 of those together somehow a collection of best of breed is just really, it's fundamentally false. It's inaccurate. But yet our industry believes that, but you outside our industry and the rest of the world is not, they don't tend to operate that way. So I do think that, again, more and more firms are getting it right now, but I think there was maybe a period from, 2005 to 2020, where like, there was like an explosion of new fintech solutions, and people were so giddy to be independent for the first time. They're just like, buying all these tools. And then they, if they really did an audit of like what value they're getting from them, they would realize that I'm getting really not high value. It's limiting my ability to scale. It's not delivering a, best in class client experience or client outcomes. So yeah, it's really interesting. We actually see even really large firms, they kind of have, there's a fair number that are actually very interested in trying to simplify and kind of create almost like a unified platform now. Whereas all the rage for the longest time was this notion of like build a stack of best in breed solutions, which I don't know if that was very
Yeah, I agree with you. I think that peaked. You go around some of these trade shows and it's like, what, who, how, who thought that was a good idea? And a lot of this was because there was a lot of money in the system, a lot of venture money, and you all raised an astoundingly large amount of money over the years. And Vanguard is famously on your cap table. They are not the type of company that just throws money around willy-nilly. So to date, you've raised $600 million. And I just assume that some of that is because there are like cash requirements. That's an awful lot of money. Is it that expensive to build what you're building, or is a large portion of it for regulatory purposes?
Yeah, I mean, so there's certainly some for regulatory purposes. A good way to think about it is that a custodian's likely going to be required to hold like 10 basis points or so relative to the assets they have and reserve requirements. That number will go down as you get bigger. So if you're huge, right, if you have 10 trillion, you're not paying, you're probably more like 3 or 4 or 5 basis points. But that number starts high, it might be like 25, 30 basis points, and it goes down the bigger you get, right? But yeah, so some portion is going to be reserve capital. It's going to be sitting in your broker dealer. It's all publicly disclosed. Like you can go download the audited financials of basically every broker dealer and see what's on their cash balance on the balance sheet of their BD. So, but it's actually a very small amount of like the 600 million. So we still have, I'd say like a very large portion of that, multiple hundreds of millions of that is we still have it in cash. We don't have any debt. It's important for people to have a financially stable, secure, sound custodian. But to build an actual custodian, if anyone wants to know, if they want to come out and join us in the water, they want to go build one, it's about $250 million is about what it takes. Like if you can't raise $250 million, don't bother trying. It's hard. And the surface area of building a custodian is immense. Like it's not a non-trivial product to build. We've been building it for over 6 years. We have 500 roughly employees. The majority of our people are engineers and builders, not like back office employees. We work borderline unhealthy amount of hours, maybe not borderline, probably well beyond the border. I certainly do. I mean, most of the team follows the suit. This is not easy. It's incredibly hard. And then on top of that, to your point, we're competing against companies that are out resourcing us 100,000 or 1 million to 1 in terms of like, the size of dollars they have on their balance sheets. So it's not trivial. Like you got to go hard if you want to do it. But I think that what's interesting about like the why, how were we so successful in raising money? Well, I think in the industry, yeah, it's not crazy hard to go raise $1 million or $2 million of like seed or Series A and pursue some idea with a limited upside. If you were to talk to really smart investors, they'd say there's 2 areas in wealth specifically that have the highest amount of upside, right? One is where you charge in AUM. So it's going to be asset managers and RIAs, basically. And the other is custodians. Nothing else has the same ability to reach scale, right? So like, so yeah, there's a ton of other tech companies, but the reality is like a really, really successful like fintech software application pricing in SaaS. If they can get to 20, 30 million of revenue, I mean, that's like, top 1% of all time, if you're a custodian and you reach scale, you're going to have $1 trillion plus of assets, which means you're going to be a couple billion plus of revenue. You're going to have $500 million or more of EBITDA. You're going to be a $20 to $50 billion company, right? So investors are much more willing to go, do we believe in this team to pursue this massive idea? And when you have a market where, you look at the RIA assets are probably $8 or $9 trillion, doubling roughly every 5 to 6 years. And you have 2 companies with 80+% market share that generally people aren't happy with. Like, it's not like people are doing cartwheels and, celebrating how awesome their custodians are these days. So it is a massive opportunity. There's a big need if we get this right, but that's part of the story. Like, we've been successful because we've built a really good product that advisors like. We've raised a lot of customer assets, serve a lot of advisors. All that signal rolls into like, this is probably the team like that's going to solve this. And now it's much harder for someone to catch us from behind because the capital markets are not quite as fluid in venture as they were 5 or 6 years ago. So it's kind of like if you believe big time in RIAs and you're thinking custody might be an area that you want to be part of, it's Altruist or bust, right? Like who else is going to catch Schwab and Fidelity at this point? And from a startup perspective, now, obviously there's like adjacent competitors that might come in here, but it's been a really interesting ride so far.
Yeah. So I want to share a chart that lends to what you're talking about. But before we put this on the screen, I don't think you've ever, and I'm sure if you never have, you probably don't plan to do it now, but you've never disclosed the assets on the platform, have you?
No, we keep it confidential, but we'll probably, I think probably in the next year or so we'll share more. But yeah, it's what I tell people is like, it's many tens of billions, but we're not quite to 100 billion yet in assets. So that gives you an idea. When we hit 100 billion, we'll tell the world. And
okay. All right. Yeah. No, that helps. Okay. So John, chart on, please. Let's show the Schwab Robinhood chart. So I was talking about this with Josh yesterday, and it is astounding. Here's what we're looking at. The market cap of Schwab divided by the market cap of Robinhood. And this peaked in 2023. So not very long ago at 22.5 times. That's how much. That's the multiple of Schwab compared to Robinhood. And now, 2.5 years later, holy shit, Robinhood is now, Schwab is now only about 2 times bigger than Robinhood. So this speaks to either, you could chart off, please, either the demand for what Robinhood is doing, or maybe it says more about Schwab.
Yeah, I mean, I think there might be a little bit of irrational behavior in that Robinhood price.
Perhaps.
I think their revenue's probably around 4 billion or 3.5 billion.
Let's just say that the premium is rich, but let's say it's in the right direction. There is a reason why they're getting that multiple.
Yeah, no. So I think so. I think now what I think will be curious here is how well Robinhood executes on like their adjacent to active trader businesses. Because at the end of the day, the vast majority of that revenue is coming from individual investors trading their accounts.
It's crypto, it's options.
Yeah, it's a bunch on cash still. I mean, like there's a lot there, but one of the metrics that we often measure, not often, we measure it every day. We're religious about it, but it's a acronym we call ROCA, which is revenue on customer assets. And if you look at Robinhood, it's north of 2%, right? So they're monetizing better than 2% on customer assets.
It's pretty good.
It's also not good for customers, and it's not sustainable long-term. Like you'll never reach scale at 2%. If you look at the advisor business of Schwab, for example, it's probably more like 12 basis points. Mm-hmm. So if Robinhood wants to mature into this, kind of diverse, financial services company that's serving RIAs, they're serving active traders, what they're doing on they want to build their robo-advisor Robinhood strategies, right? Like if a lot of their adjacent business lines take off, their ROCA will decline substantially, right? Which is natural. Like that's what happens. Like even if you look at Schwab's business and you break it out and you say, well, what does Thinkorswim generate compared to Schwab Institutional? Thinkorswim's probably north of 2%, just like Robinhood is. But the problem is the addressable market of active traders is just not trillions of dollars. I mean, it's certainly not tens of trillions of dollars, right? Like the cumulative active trader market in the United States is add up all of active trader at, Robinhood, E-Trade, whatever, even, I don't want to call Fidelity active trader, but they probably have some traders, interactive brokers. If you put it all together, it's probably not even close to $1 trillion. So you're never going to reach Schwab's level of revenue on active traders, right? So even if you're at 2% ROCA, you have to get to north of $1 trillion of active trader assets to get to 20 billion. Schwab's at, I think, 25 billion of revenue. So I think there's a lot will be how good does Robinhood execute on these other business lines, and what does this do to their ROCA as they try to get to $1 trillion in assets? What's interesting is Altruist will probably reach $1 trillion faster, maybe materially faster than Robinhood will. But as you can imagine, the ethos of Altruist, think about our name. It's the ethos of the company is we want people to do better with their money. Why did Vanguard, you mentioned them earlier, why did they invest in Altruist? Why did Bill McNabb, who was their chairman and CEO, invest and join our board? It's they wouldn't have joined if our pitch was, we don't really care that much about how clients do with their money, but we're going to make a shit ton of it ourselves, right? That does not resonate, I think, with most human beings actually, but certainly not our cap table or me. So yeah, I think, look, they're killing it from a product execution perspective. Their product is incredibly good. Their speed of innovation is completely bonkers. I watched the video Vlad posted yesterday. He was in Monaco or something, about tokenizing securities, which we're a long ways away from tokenizing stocks and bonds, because you have to get the entire market to come along for the ride. Right now, they could tokenize their own inventory. And if anything, that's probably going to make the execution even worse than their already industry worst execution, at least for a while. So we'll see. Sometimes there's a hype and there's not as much substance, but that's what they're trying to do. Because the active trader market, they're already kind of doing pretty darn well there. But again, the total assets in that pool are just not big. So love the UI, love the UX. I actually think super highly of Vlad. I think he's pretty incredible, kind of product visionary leader, and insanely smart too. But if someone was to ask me what stock will perform better over the next decade, I don't think it's as obvious as that chart would suggest. That chart would suggest Robinhood's going to catch and exceed Schwab here in a few years. I
would take the under on that, even though I like you, I'm very impressed with what they're doing. All right, we've got 10 minutes for two more questions. So I want to talk about advisor tech, specifically with AI. You posted on LinkedIn, if you're trying to use AI to do paperwork for account opening and servicing, I think you may have missed the assignment. So you all recently bought Time, and you rebranded it. So what is on the roadmap for AI with Altruist, and what is your take on the broader ecosystem?
Yeah, I mean, I think it's incredibly exciting. And so, huge props to anyone trying to build a killer AI solution for advisors. The comment, really what I was getting to is like, if your infrastructure is so bad that your solution is like, let me throw some AI on that pig, it's like, that's just like the pig's the problem here, right? So in other words, if your custodian's making you fill out paperwork, that is the problem, right? And the AI should be doing something a little bit, more high value than like making up for the shortcomings of your custodian, or whatever paperwork you're filling out, So, yeah, I mean, our view is basically, phase one is what I call a general purpose assistant. Like, we're already seeing some of this in the market. They've been in the market for about a year. Started with note takers, like, hey, do a meeting, listen, summarize it, help me create a little follow-up, feed it into my other tools and systems. And that's a nice win. It's easy. It's kind of low lift, doesn't feel too risky. And when advisors try it, they generally are, I haven't seen too many people who are like, yeah, that was a bad experience, I'll never do that again. I think most people are like, whoa, like this is actually really helpful. So we needed something like that. That was, sort of like our industry's version of ChatGPT, like just easy, simple, low cost, and produces an outsized ROI. Like that was the entry point. But if you're really being critical, that doesn't really solve a job. Like, you wouldn't hire somebody just to follow you around and take notes. Like if you're thinking about a real assistant, the real assistant does more. They're going to help you with your calendar and your email. They'll actually be responsive to clients. So a client reaches out, they'll be able to help do some of the research. Like if a client asks a question about, hey, what's my RMD this year? Have I taken any of it? Hey, can you remind me what the beneficiaries are on my Roth IRA? I just updated my estate plan, and my attorney said I should check in on that. Like, these are all things that a regular assistant would just log into your systems at your office, and they'd be able to find this data and they'd be able to service it back to the client. So where we're going is, like, in phase one, a general purpose assistant. It'll do a lot more than note taking, though, because we want it to be a bit more agentic and be able to be responsive. And, we'll still make it a co-pilot initially. So advisors will be able to be that, like, approver before any work's done or messages are sent. But we just want to be able to do a lot more. And a custodian is, there's been a little debate, of course, I'm biased here, but I think a custodian is the actual source of truth, because if you have a client who dies, it does not matter what's in your notes or in your CRM. It matters what's at your custodian. Like, that's the reality. If there's a tax, loss you're trying to harvest in an account, it does not matter what's in your portfolio accounting system or in your CRM or in your notes from your meeting. It's the cost basis that's actually in the tax lots at your custodian, right? So I think if we want to get more advanced and do more things, the custodian's the central kind of actor of data. And the data, I think everyone understands, that is what's paramount to make language models really work, especially if you kind of tune them and you want them to be incredibly accurate, right? Like basically better than human level accuracy. But we'll be launching that this summer. So, like, we already have people using it right now, just learning, refining, probably launch it publicly in August.
When you say publicly, is this for Altruist users only, or are you going to expand it beyond?
No. Great question. Yeah, no. So we set up our AI as like a completely different product, and it can be used by any advisor. So now it'll natively it'll be real time, omnidirectional with Altruist. So if you're an Altruist user, it'll be extra horsepower. You can do more stuff, like do stuff like a human could actually do. Schwab, Fidelity, et cetera, like most of them don't have APIs for most things. And even then, like with AI, you really need something called Model Context Protocol, or MCP, if you've probably seen that news. And they definitely don't have that, So getting them to do stuff for you, your other custodians, will be a bit more challenging, but it can still do a lot of stuff that a human could do. So it's called Hazel.ai. People will go sign up, and and they'll be able to use the general purpose assistant. The next two assistants, so we're kind of building two more agents. The next one that will come online will be a paraplanner. Again, it's meant to be a proactive AI. So you got a client, and if you came through and said, look, an ideal client experience is I do these 25 things for every single client. I want to look at all the risk in all of the different types of insurances they should or shouldn't have. I want to look at budgeting. I want to look at savings rates. I want to look at their investments, of course, their broader financial plan, retirement goals, but right? Like whatever they are, everyone might have their list of like, this is what really great planning looks like. delivering that at scale is really hard. And there might be gaps, holes, policies lapse, savings rate changes, but a great paraplanner is looking at everything every day. And it's just surfacing like, here's all the opportunities you have to create more value for clients.
Yeah, that role's going away. The power planner is just going to be decimated, which is unfortunate for the younger people trying to get in. But for advisors, it's going to be a big game changer. All right, Jason. Last question, and my God, am I frustrated that I put the wrong link in the calendar? So we had to cut this short. So I apologize again for you and for the listener. Okay, so when you started, it was natural that you were going to work with younger advisors who were more nimble, who had less at risk, who didn't have $2 billion at an existing custodian. As you've matured, I'm sure this stigma, I feel like that would be how you would describe it, of, oh, Altruist is only working with these advisors with $7 million. You are a big player in the space now. That stigma is I think untrue. I want you to correct the record. So where is Altruist today, and where are you headed in the future? Who's going to be your customers?
Yeah, no. So, I mean, it was very intentional. I think any novel technology, you need early adopters, and who's most likely to be an early adopter? Probably a younger person earlier in their career, clients more tech savvy, et cetera. So we were very specific. Like, we were actually targeting in the first couple of years advisors with under $25 million of AUM, right? So market no one would ever even pay attention to.
Smart.
Some of those advisors now have over $1 billion, right? So 5 years later, there's one advisor that went from 10 million to 1.5 billion, completely bonkers growth, right? But what's happened though, the products evolve, surface areas change. Now the core advisor that uses Altruist is just a high growth advisor. And so, I actually just the quarter, closed out. So I looked at our Q2, and we had the fastest growing organic advisor did about 450 million of totally organic, brand new, net new in Q2.
Holy
just in a
shit,
quarter.
Name
right?
Names. I'm just teasing.
No, I can't quite give this person's name away. The number 2 advisor did 350 million, and the number 3 advisor did 280 million. Wow. These people are not small. These are not small firms. They're not slow growth firms. These firms are growing at insane annualized rates. I think what's happened is as soon as people start using the product, if they're high growth, they're onboarding, hundreds of clients a month, there's just no better solution. The ROI is it's so obvious and objective. And now the product's ready. We've done enough integrations with other tools at bigger firms. So I think that, I'd be honest, the sweet spot is still high. It's still organic growers. I mean, at the end of the day, we don't really target the $50 billion firms that are doing a bunch of roll-ups. And a big part of that is the really huge firms, they have a silent business partner that actually controls them, and it's the custodian sending them referrals. So why would we bother going up and going after a firm that basically they cannot move their money even if they wanted to, because if they did, it would put in jeopardy their only mechanism to grow. So, we do tend to stay out of the biggest firms in the entire world, whatever market, because they're almost all getting referrals, and that's their lifeblood of their business. But if you look at the firms of the future are the firms that are they're adding, tens or hundreds of millions or even billions per year of organic assets. They're killer marketers. They're real CEOs. They're really building businesses. That's our bread and butter. And so we really try to bespoke our entire roadmap and how we think about things, how we build things for those firms. And so it's been a ton of fun to actually grow with some of the most exciting, fastest growing firms out there.
Well, Jason, I want to thank you for your time, congratulate you on all your success. You are sorely needed in this industry, and the proof is in the pudding. So thank you for joining us. And if you want to learn more, altruist.com.
Yes, sir.
All right, Jason. Thank you.
Thanks, Michael.